Good evening, everyone. I am CA Nilesh Bajaj, moderator for this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be moderator for the webinar on Standard Auditing 700 series on reporting and practitioner's view, and the second topic, recent challenges under GST. In a short while, we will start this webinar. First, I would like to appraise you about the CPE committee. In today's ever changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adopting the new requirements and norms. Therefore, it is imperative to aim to be up to date, to offer unique guidance, influence others with the innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, the continuing professional educational facilities professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. The program for this evening is as follows. We will have two sessions of 1 hour each, and the topics are standards on auditors reporting, practitioners and regulators view. And the second session is recent issues and challenges under GST. Our eminent speakers will talk about the above mentioned two emerging areas of the professional interest. To start this, we have with us our chairman, Purushottam Lalji Khandelwal, CA Purushottam Lalji Khandelwal, and I would like to just give a brief about him. He is the chairman of CPEC and convener of RBA Directorate and of ICAI. He is having 25 years of post-qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he has devoted to 45 CPE framework, guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading the CPE portal for enhancement of branding and professional competency of members. I would request our chairman of the CPE committee to give his remarks.
Good afternoon, respected faculty, CA Anant Marwaji, Rachit Aroraji, Chairman of Navi Mumbai branch, Nilesh Bajajji, Secretary of the CPE committee, Ajit Naji Tiwari, and respected members, those who are watching these programs. CPE committee is the mother of all the committees, and my committee is dedicated to organize a conference, seminar, half-day seminar, full-day seminar, workshop, RRC, for the updation of knowledge of our members. This year, my committee is coming with a technical app which will record the attendance by just enter OTP in the mobile and your CP will be updated. ICI is celebrating a 75th year this year, and we have done a lot of work for the members and students at large. Audit is a serious business. A regulator, not only ICI, but NAFRA, is closely watching the financial statement signed by our members. They are imposing a huge penalty on the auditors, signing partners, reviewing partners. So my humble request to all the members, those who are in the attestation function, please take audit as a serious. And today's faculty, Anant Marwaji, is expert in the subject, and they will guide you about the practitioner view, regulator view. So I will not take much of time. A second faculty, Rachit ji, will also guide in the GST. So my request, Nilesh Bajaj to take a program further because the member will be benefited. I will not take much of your time. Thank you. Thank you so much.
Thank you very much, sir. Thank you for your valuable advice and guidance. Now moving on to the session, and today's our first speaker on standard series on reporting and practitioners view. So we have with us CA Anant Marwaji. He has more than 20 years of experience in the field of audit related services. He has been part of the quality review team and audit methodology trainers group of India audit practice. He has also been speaker at ICAI, RBI, business schools and various other platforms for sharing his knowledge in the area of audit. So I hand over the first session to CA Anant Marwaji.
Thank you. Thank you, Nilesh. Uh, Hello, everyone. Very, very good afternoon. I would want to start with a very heartfelt uh, expression of gratitude to Chairman Shri Purushottamji, uh, Vice Chairman ji, who is not here in the session right now, Ajit ji, and the entire team of the CP committee for having me here. And And in this deliberation on standards of auditing and the practitioners and the regulators' view, uh, when I was having sort of discussions and reflection on what all should be covered in this 1 hour session today, with a group of practitioners who are auditors, tax consultants, and possibly also people from the industry. What is it as a message that should be shared with you based on my experience as an auditor for the last 20 years, as a signing partner for several years, and also based on all the interactions that I've had in all the speaker sessions at various institute or study circle forums. And there are a couple of things that came across. One is that, and I'm also referring to one of the things that Purushottamji mentioned in his remarks when he has been saying here and in the other sessions that even for the institute and its members, they would want us as members to take the importance of CPE credit and the sessions very, very seriously. And therefore, with the overhaul of the structure, what the institute is also telling all the members is अगर पहले एक्शन नहीं हुआ तो ऐसा नहीं है, it will not happen now. This is our institute telling us. We are the members of the profession, we are the torch bearers, and it is for us to be being able to act professionally. We need to do this. Having said this, you look at what are the other regulators saying. What is the audit regulator saying? And then we will understand and be able to appreciate that the regulators are actually telling us that they mean business, that they would want all businesses to behave in a fashion which is more in line with the legal requirements. And such is the state of the audit profession. Okay. As I go further, as is the norm, I would need to set up the slide deck, which I will in a short while. But I must tell you that for about 40-45 minutes of time that I have for this session, I have about 50 slides. Okay, which essentially means that there is no way that I can run through those 50 slides in this, and that's not the intention also. The way I would want to run it is that I would want to share with you some key messages on two aspects. The regulator current view on the profession. Okay. And then we would also want to touch upon, I would also want to touch upon the some of the nuances of reporting standards, which must be kept in mind given the changed scenario. Okay, is it all good? Is the voice loud and clear, Nilesh ji? Is the slide visible? Then I will proceed.
Yes, sir, it is visible.
Excellent. Thank you, Shai. Okay. Giving you an initial context, as I said, I would want to sort of talk about uh, the regulator's view, and then I'll move to some specific reporting standard areas. Okay. Now this is a very talking slide. Okay, and it will be good to understand as to what do you understand when you see these boxes. Okay. First on the blue box. NFRA, National Financial Reporting Authority, Disciplinary Committee, and other sort of committees of ICAI, Ministry of Corporate Affairs, ROC, SEC, which is the US regulator for stock markets, PCAOB, uh, Public Company Accounting Observation Board, that's the regulator for the audit profession in the US, ED, SFIO, RBI, IRDA for those regulated entities, SEBI, uh, ICFAR, which is the interconnecting body for international regulators for the accounting profession, and many more. This, ladies and gentlemen, is a short list of certain of the regulators that the profession has to deal with. The key point being that the regulators are interconnected, that they have access to the information much more than ever before. You would be aware with the changes in corporate law, there is a requirement to maintain audit trail. There is a requirement to maintain books of accounts in India for companies, uh, which started last year. With all of that, they have access to information, they have access to data, and clearly, by the recent action that we have seen by all the regulators, RBI sort of revisiting in inspections, penalizing large banks, payment banks, etc. Similarly, and putting penalties. Similarly, NFRA coming up with their orders, inspection reports, debarments. ICIS has come up with orders and sort of rap on the knuckles for members and all regulators. The clear message is that the regulators mean business. The green bucket. Some of the statistics of what the NFRA, the new regulator for public entities in India, uh, has sort of done over the last some years when they have been in existence and more active. 1 October 2018, the year when NFRA was actually constituted under the law. 132(1), the section of the Companies Act through which they derive their powers. Number 2, that's the number 3, number 5, and number 72. 3 is the number of circulars that they have issued so far. 5, number of inspection reports that they have issued so far. 2, the conferences that they have done. Number 72, that's an alarming number. That is the number of orders, disciplinary orders that they have issued so far. That's the count that I did last evening, and that is also the number of debarment orders that they have issued for members. So therefore, the state of affairs for how the regulator is looking at it is very, very serious. They mean business, and it's important that we understand that when the regulators are trying to give a very strong message, it is important that the way the businesses are done, the way the profession is run, the way audits are done and documented, and the way audit reports are are written. All of that is revisited to match with the requirement of how the environment is changing. The focus really is going to be on reliability of financial reporting and audit quality. That incidentally was also the theme of the 2 day international conference that NFRA conducted in the month of March. It is evident that the regulators and the government of India is looking at not only dealing with reality but also change the perception of how Indian financial reporting is looked at in this community. There has to be a better focus on communication, what we communicate, how we communicate with board members, with the promoters, with the regulators, with the media, and a very strong focus on technology in the audit. Just like Purushottamji mentioned, that is, one of the agenda items for the committee this time is to automate credit for CP hours. Now that's this domain. Similarly, the audit trail, the use of IT in how a company conducts its business or how a business is run, and then how an auditor uses technology will be a very important aspect as we go forward. This is only showing some areas of audit methodology where an FRA or any other regulator has come up with a observation. And look at the varied number of areas where the observations have come. Understanding of the business activity and nature of transactions of the auditing, that was questioned. Determination of materiality. What amount is material for an audit? Materiality is a concept where members would understand below which something may be immaterial. So if it's an error, if it is an immaterial error, one can ignore it. But if it is above a materiality threshold, then either the adjustment entry should be recorded in the financials or it should impact the audit report. The audit report should be considered for a modification. Performance of analytical procedures. There were observations of that by NAFRA, of course, applicable to companies. Then failure to communicate with those charged with governance, which is the board members, the promoters, the holding company representatives. There was not enough communication. Let me move forward. This is an important slide in the context of what we are discussing today on the reporting standards. There were observations around, look at the item number 3. The emphasis of matter paragraph should not be misused to report matters which should actually have been a qualification. So one must appreciate that the reporting standards, the 700 series, 700 is the general audit report standard. 705 is on modified audit report. 706 is on emphasis of matter and other matters. And then there is a standard on 701 on key audit matters. There is specific guidance on each one of them as to when they should be used and what they are supposed to communicate in an audit report. Very essential for us to understand the difference and not use one against the other, because the regulator has picked these as observations to say that the auditor did not demonstrate the right level of understanding or use one against the other. Okay. Use of modification of a report in case of an internal financial control opinion also. Members would be aware that if there is a observation on internal controls, what is the impact of that on the main audit report? That also needs to be kept in mind. What is the way forward for us in this? When the regulator is looking at things with this level, with this level of seriousness, it is very important that we take certain tangible steps. Key focus that one needs to do. The auditor, whether you are auditing a promoter company, whether you are auditing a partnership firm, whether you are auditing a proprietorship business, whether you are auditing a listed entity, it is important to know the regulations which are driving the business well. Business regulations, operational regulations, law. Understanding the internal processes and controls, including the IT, the information technology controls. NFRA in the 2 day conference actually dedicated a good amount of time where they said, is the auditor community asking the right questions to the management? What does that mean? Asking questions which are not just information seeking, but which are corroborating, which are incisive, and which demonstrate what in the theoretical language is known as professional skepticism. Corroborating information, asking X and then going and asking Y, similar question to see is that matching, does it make sense? Communicating with the board members, the audit committee, the internal audit team, focusing on the quality and the content of the communication also. And remember, the communication has to be verbal as well as uh, can be verbal as well as in written, and it has to be both depending on what the standard requires. Extremely important is the other bullet. Now, the auditor may have done all the right work, asked the right questions, got the right level of evidence, agreements, vouchers, copies of underlying documents. But if the same is not documented well, what does it mean? Which means, what did I ask? What did the management, what does the client say? Is it appropriate or not? All of that needs to be documented. Minutes of meeting, basis of conclusions. Why does the auditor believe it is okay? All that needs to be written down in the working papers. Because just like for a doctor, there is a prescription, and that prescription, in that one sheet of paper, the doctor would write everything. On the left hand side, we have all gone to a doctor, right? On the left hand side, he will write basic statistic parameters. On the top, name, age, etc. Left hand side, they'll put down the current symptoms and history. Then they'll put down the prescription, test required, and then he will sign and date it. Now, for us, given the standards requirements, it's more expensive. So it starts from the engagement letter, which puts down the terms. Then it is about the work done, the audit evidence taken, the documents seen, the sampling done, the controls tested, the interviews done, the external confirmations taken or external evidence taken, corroborated. Put that all down on paper. Follow the auditing standards in letter and in spirit. There are checklists available. I think the CAQ has done a wonderful job coming up with the IT tools, which also have checklists, engagement letter drafts, etc. Uh, those should be used. There are checklists available for auditing standards, accounting standards. Standards need to be looked at by the team members. And then, most importantly, and that has also been a discussion. There's more two-way communication or interaction when you are in a when you're in a room versus this online medium. But I think members would come out and say, how do you do so much when the fees is so little because the client just doesn't want to pay? Uh, the message is, even from regulators like NFRA, and the chairman of NFRA has gone on record, said it. We have heard this in all ICAI forums. The audit committee members, chairs are saying it, that they recognize that the pricing for an audit needs to be better. It needs to be enhanced to recover the cost of audit, which is increasing by inflation, by the need of infrastructure that an audit needs. There are conversations around how to upskill the profession. Mediums like this are a good forum by which there can be exchange of ideas, uh, discussions, deliberations, learnings, by which we can enhance our knowledge, gain from experience of other members of the community. And but none of this will actually substitute reading the standards themselves. One has to read the standard, get the key aspect out of it, because that is what is going to actually decide. And if you saw the observations, if the regulators are actually picking up observations as detailed as something like materiality, something like need to focus on the right level of documentation, then we have no choice but to actually do it and therefore price it accordingly. Yeah, we move forward. Now, is there on the chat pod? Is there? I just want to pause and ask while there's a Q&A session at the end. Is there any thought, comment, question that anybody would have in the group at the moment?
No, sir, there is no chat bot.
There's no chat pod available.
No, sir.
Okay, okay. The question will come directly then. Okay. So moving forward then.
We will share the questions in the end. I mean,
Yeah.
okay.
So just to sort of summarize what we have discussed so far in terms of the regulator's view, essentially it is the focus needing to be on we bringing about a change in the way the profession is being run, the way the auditors uh, go about documenting their work, pricing it, and reaching the right conclusions in an audit report. Now I would move to the audit report itself. Okay. And what you see on the screen are the key ingredients of an audit report. Start with the title, the addressee, the auditor's opinion. The opinion paragraph comes up front. That's a change that was instituted when the SA 700 was revised a few years back. So, so the opinion which used to come at the end now comes up front. Identifying which entities' financial statements are being audited, which period is being audited. Then there is an assertion on auditor's independence. The auditor has to confirm her, if it's a proprietor, or the partnership firm, if it's the firm, their independence. And that is a very, very, very key aspect of an external audit. The group would appreciate that. Important to mention here that one of the key observations from NFRA, the National Financial Reporting Authority, is around this of firms doing non-audit services which may be considered non-permissible for an auditor, and that's an area that one must look at, whatever size of the company or auditee that we have, and whatever may be our size. And that also requires us to rethink the arrangement. There are the practice of somebody maintaining the books and also auditing. Wherever that still exists, needs to be revisited. The engagement letters need to be more clearer and watertight to that extent. Basis of opinion, that's what I was mentioning. Even in the audit report, one needs to clearly mention what is the basis of opinion that we have whether if it's a qualified report or an adverse report, if there's any modification in the opinion, if it's a clean opinion, that's fine. If it is modified, then there has to be a basis of opinion saying why we think we are modifying the opinion. Key audit matters, essentially matters of significance, importance, which we think are important for the readers of financial statements, again, requiring judgment of the auditor. Number eight, management's responsibility. We all understand this. Whether you are a practitioner, whether you are a consultant, whether you are from the industry, you understand that the primary responsibility of the financial statements resides with the management, with the company, with the promoter, with the proprietor, and the staff. And that is clearly brought out. The auditor's responsibility then governed by the law, governed by the auditing standards, is brought out. And then there are other reporting responsibilities. So it's a company, then there are specific sections deriving what should be mentioned in the audit report. Thereafter, auditor's signature, place of signature, date of audit. Important. Date of audit report is important because that actually signifies till what date is the auditor responsible for the subsequent events that may have happened and that are important to the auditee entity. So, for example, if let's say, God forbidding, there was a fire at a factory, should the subsequent event be accounted for? What date it happened is important. Is the audit report dated before or after? If there is an adverse tax notice or a demand or an adverse court order which requires a determination of a liability or of a provision or a contingent liability, all of that will be relevant from a subsequent event perspective. That should that be accounted for in the financial statements for, let's say, March 24 year end right now, or should that be deferred? Is the management not responsible to look at all of that? They are. But is the auditor responsible? Till the date of signing, they have a specific set of responsibilities. Post signing of the audit report, up to the approval of the accounts, audited accounts in the shareholder meeting, for in case of a company, they have a separate responsibility. And going forward, all of that driven by the standards of auditing. This briefly puts out types of audit opinion, uh, modified, unmodified, and under modified, we could have a disclaimer, an adverse, or a qualified opinion. And I mentioned that there are separate standards which govern all of this. Okay. I thought one way to go about this, while we may not be able to have a chat dialogue in the format, is to actually maybe let all of you look at something in a Q&A format, and therefore then do a self check, and I will talk about answers to all of this any which way. What type of assurance does an audit opinion on financial statements provide? Does it give you a positive assurance? Is it an absolute assurance, a reasonable assurance, or a negative assurance? You could answer it in your mind. You could pull out a pen and paper and write. Essentially, it gives a reasonable assurance. It is not an absolute assurance. That is important to understand. Fundamentally, driven by auditing standards, but important to know that we give based on information and explanations which are made available to us by the management, based on corroborative inquiries, looking at documents, doing test checks. We give a reasonable assurance as auditors. So that entire theory of are we a bloodhound or are we a watchdog as an auditor, and should the watchdog change to bloodhound given the scenario, all of that needs to be seen in the context of what is the expectation from us as a statutory auditor. And the statutory auditor's expectation remains a reasonable assurance. Okay. However, one must not lose sight of the fact that it has to be not just, audit. Essentially, is always looked at like a postmortem kind of exercise where somebody has done the work, they have posted the entries, and we come and subsequently go and audit it. But I think in the changing scenario, while it is a reasonable assurance, we must keep in mind that the expectation is not just to look back and do a post-mortem kind of exercise, whether, was there an error done, was it complete, was the transactions recorded completely, or was it erroneous, are they accurate? There is also now an element of forward looking uh, in how the auditor's role is envisaged now, especially with the change in accounting standards, with the Indians coming in, under the new company law some years back. Fair value measurements play an important role. Going concern considerations, it's in the main audit report for a company, where one has to see when the auditor has to assess whether the company will be able to remain as a going concern. Will it remain, continue to be in business for a foreseeable period of time? Hmm? Typically seen as 1 year from the close of when the financial statements are finalized. Uh, Very, very important to have a view on how the business is being looked at going forward, the company's projections, the company's uh, future business outlook, binding contracts, agreements, any litigation that could actually, harm them adversely. All of that will be important, even in the context of a reasonable assurance, because one has to look forward also to see what will happen, in our best opinion, to a company or to your client going forward, required by the law, required by the standards. In case of a company, who should the audit report be addressed to? Should it be members? Should it be board of directors? Or, the classic, to whomsoever it may concern? In case of a company, to the members. Important to bear this in mind, because, for certificate, there used to be a time when certificates at least would be issued as to whomsoever it may concern. No, it's clear for the promoters, for a proprietorship firm, it has to be the owners. For a company, it has to be the shareholder members. In case of a special audit which is driven by management, then it could be to the board of directors of a company. Question 3. Which of the mentioned matters are not required to be given in an audit report? Going concern, we talked about it. There is a specific mention of going concern. Litigation, company law specifically requires, talking about pending litigation and whether the company has accounted for it appropriately in the audit report. Materiality and management representations. These are not required to be given in the audit. Neither the company law requires it for companies, nor does SA 700 format of an audit report require. Okay, but important to know that, these are important. So materiality is an important consideration which needs to be reported to those charged with governance. That should not be missed out. And management representation is an important piece of audit evidence which the company or the client, whether it is a promoter or a partnership firm, that business entity should give a representation to us, confirming that they are complying with the applicable financial reporting statements framework, that they have given us all the information and there is nothing that is pending for us, basis which our opinion could have been something else. Okay, question 4. Mr. Sam and Satya are joint auditors of X Private Limited from two audit firms having different opinions on a specific matter. Okay, joint auditors different firm, but have a difference of opinion on a matter. Will they issue one report or will they issue two separate reports? The standard permits them to be issuing separate reports, clearly laying out. Important here is again the importance of documenting as to what is each auditor's responsibility. So there should be actually a document signed between the two joint auditors and the company as to what is their individual responsibility and what is their joint responsibility. For example, somebody could say, I will audit revenue. The other says, I will audit fixed assets. And then financial statements could be joint responsibility and such way there. But that has to be documented. If there is a difference of opinion on a matter, they are both very, very within their rights to issue a separate opinion. Apart from including in the auditor's responsibility paragraph, there is a requirement for all entities to have a separate paragraph on going concern in the audit report. We've discussed this. So therefore, the answer is yes. It is a requirement under the auditing standard to specifically talk about the going concern assumption of the auditee. This is driven in the auditing standards. A qualified or modified opinion is the same and can be used interchangeably. See, these look like elementary questions, but how many times have we, I mean, in all my interactions at NIRC, at other forums, is how many times have we seen a qualified report? How many times do we see or have we issued an adverse report? Very, very few. And that is what the regulator, in their limited time, the NFRA, for example, in the last few years of existence, that's what they are saying. That X practitioners should have qualified the report, but they didn't. They should have qualified, but they issued a emphasis of matter paragraph in the report. And therefore, it is important to understand as to what is a modified report and when it should be modified. The question here is modified same as qualified? The answer is no. As we go back to the table that we initially saw, modified can be either qualified, adverse, or a disclaimer. Modified and qualified is a subset of modified. Yeah. If an auditor was to qualify the audit report, should the qualification be in bold or italic for easy identification? That's important for the readers who do not know the nitty-gritties of law well. When you are to qualify, will you put it in italics? Will you put it in bold necessarily? The answer is no. That was used to be the norm, but that is not needed. Should not be done. The report clearly will actually write the type when in the opinion paragraph it will say qualified opinion, and then the basis of qualified opinion. So it will be crystal clear on the top of the audit report that it's a qualified report or it's a disclaimer report. It doesn't have to be bold or italics. A company has incurred loss during the year. Which of these paragraphs for a qualified opinion is appropriately worded? The green one or the pink, mauve, magenta? This one. What is the difference between the two? Let's just go back. Should we use the word subject to when we are qualifying, or should we use the word except for? The regulators have also questioned the terminology used. So let's be mindful. The standard expressly says we should be using the word except for. So it says, in our opinion and to the best of our information and according to explanations given, except for the effects of the basis of qualified matters, the aforesaid financial statements give a true and fair. Should we be saying profit or stroke loss? If it's a loss, it should say loss. If it is profit, it should say loss, profit. moving forward. I've hardly come across actually not more than two in the last 7 sessions that I would have sort of had with the members community, where they would say we have seen or we have issued a disclaimer. When you issue a disclaimer, the message in this question is we do not say that we have completed the audit. Look at how this has to start. It has to start with we were engaged to audit the financial statements. We don't say we have audited in the when in the audit report. And this is how the standard also has illustrations. SA 705 has illustrations which talk about this. This is how it has to be worded. But we should not clerically miss it, because that will tantamount to an inaccurate, inappropriate report. Please be mindful of that. We were engaged to audit financials of ABC and Associates. And then we say we do not express an opinion on the accompanying financial statements. Because of the significance of the matters described in the basis of disclaimer, we have not been able to obtain sufficient and appropriate audit evidence to provide a basis of our audit opinion. See, the base of an audit opinion is basically getting sufficient and appropriate audit evidence. If we do not have enough evidence, then we cannot say that we completed the audit to get to our opinion. Important here is also to know that if we reach a disclaimer situation, we might be disclaiming for a particular matter, but that doesn't mean that we do not look at rest of the balance sheet or P&L areas and complete the rest of the audit. It doesn't. The standard clearly says that it does not absolve the auditor of the responsibility of looking at other areas. So look at it entirely and then mention the relevant errors in the audit report, even if it is a disclaimer. That's the message in this question. EOM, emphasis of matter, SA 706. And we also saw that NFRA also had an observation around this. So in these two, which is the right way to word emphasis of matter in an audit report? Let's see what's the difference. So this is a situation where there was a fire in a production facility, and it is not a adjusting event, because this is to sort of make sure that it is understood. The company has given a note to the effect of what has happened, what is the financial impact of it. It is disclosed, and now the auditor needs to emphasize on it. See, emphasis of matter is done when there cannot be an emphasis of matter when there is nothing that the company has disclosed in the financial statement. That's the beauty of an emphasis of matter. It is essentially emphasizing a disclosure the company or the client has already made in the financial statement. If they do not have a note, they do not have a disclosure, decide if the note disclosure should have been there, then does it require a qualification or a adverse? But if there is a note disclosure and it is important enough for the auditor also to point out in the audit report, that's when you use an EOM. That's the crux of SA 706 for emphasis of matter. And when you put an emphasis of matter, essentially you write something like this in the audit report. We say emphasis of matter, we draw attention to note ABC, X, or the financial statement which describe the effects of a fire of a company's production facilities. And then you also clearly bring out this last line to say, our opinion is not modified in respect of this matter. That is an important aspect, and that is why the right answer is this. It's important to tell the readers of audit report that this is not a qualification. We are only emphasizing. So we have spoken about emphasis of matter. We have briefly spoken about disclaimer. We spoke about difference between modification and difference between a qualified report. The importance of giving going concern considerations. Now let's see what this has. This is about other matter paragraph. Now there is other than the modified audit report, one could also have a other matter disclosure in the audit report. What that means. In this scenario, it says the auditor has included one paragraph in its audit report. Since the amount is below materiality, the auditor has included it under other matter. So if something is, they have done something which is not material but incorrect, and the auditor wants to point it out, is other matter paragraph the right way to put it? So here the auditor has said, we draw attention to note X, which describe non-accrual of bonus provision. Is that the right way to do it? The answer is no. The purpose of other matter is that if there is something important which doesn't impact the opinion, but it needs to be brought out to the notice of the uh, readers. So, for example, I audit the holding company. I don't audit the subsidiaries. I audit 3 out of 5 subsidiaries. The other 2 subsidiaries are audited by somebody else. I would want to mention that so that the reader is aware that as a auditor of the holding company, I didn't audit everything. Mentioned it there. If I was not the auditor in the previous year, so the corresponding numbers. So, for example, March 24, I'm the appointed auditor. March 23, somebody else audited. I would want to mention it to them. That could be in other matters. But if there's something which is an error, then I need to decide basis materiality. That is the message that I wanted to give in this slide. Moving forward. You are a newly appointed auditor of ABC. Previous auditor has given the unmodified opinion on the previous year financial statement. Okay, we straight away come to what we were talking about. Which of these is more appropriate? Should the fact that the previous year was audited by somebody else, is that something that you have to bring out in other matter or emphasis of matter? Other matters is the right answer, for the reason that I mentioned a few minutes back. There are a couple of more questions which are messages that I want to deliver, but I'll just hold back to just check with Ajit ji, with the team. Do we have any questions lined up at this point?
No, sir, not really.
Okay, so then I will continue and then conclude. Conscious that we have about 7 odd minutes.
Yeah.
Yeah. Okay, I will skip this one in the interest of time. What should be the placement of the key audit matters in the auditor's report? Where does key audit matters for the benefit of the group is something which is relevant, and I will move to a slide on this. Key audit matters SA701, but essentially these are not a modification. These are important areas which, as an auditor, you would communicate out of the areas that you will talk with the board members or with the shareholder or the audit committee. Out of those areas, matters which required a very significant amount of auditor attention. You filter those, and even out of those which required a lot of deliberation, lot of application of judgment and mind, use of experts, lawyers, maybe valuers, high complexity, which took a more focused attention during the year. Those are the matters which are brought out as key audit matters in the audit report section. Purpose being more transparency, because the readers of the financial statements actually worldwide were saying that we don't get to know what the auditor spent time on. So this is why we have to tell them that if it was qualified, then they will know these were the big errors. But if it is a clean opinion, then they will never come to know as to what was the focal areas in the audit. So CAM or key audit matters was one way to do this. They said wherever the auditor spent more time, which was complex, area of judgment needed a different level of thinking, which was communicated with the board members, etc., those should be brought out as camps. And the placement would be just after the basis of opinion. So if you have a qualified opinion or a clean opinion, you put out the basis of opinion, and then after that you put out what are the key audit matters. Will key audit matters also be emphasis of matter paragraphs? That should be easy. Different standard key audit matters is SA 701, emphasis of matters is 706. So if there are different standards, anyways, they cannot be the same. And we deliberated also on this. They have very different purpose of what needs to be delivered. Okay. Those were the some questions that I picked up, basis experience, basis what the regulators' observations were on reporting. And also looking at institute has some years back come up with a beautiful implementation guide, uh, which on these standards, actually on the 700 series, where they pick up FAQs on bring out the different nuances of each of these reporting standards. It's a very good read, not very bulky. I would strongly recommend practitioners or their staff members to go through the implementation guides available on the institute website. I would also recommend keeping an eye on the news around what is the regulator talking. I would recommend that when you see that the regulator is giving a very clear message, it is important that we use our relationship. In conclusion, actually, now I'm sort of summarizing, we should use our relationship with our clients to pass on this message, because they look at us as experts in accounting and auditing and tax matters. So whether you are a tax practitioner, whether you are a employee, whether you are an auditor, whether you are a consultant, I think use all this knowledge that we gather and the regulator behavior to go and tell to the clients that the change that needs to be brought out cannot be done by the regulator alone. It cannot be done by the auditor alone. It cannot be done by the consultant alone. The entire ecosystem needs to evolve further. And therefore, the promoter, the management, the owner, the shareholders, the board members, all of them need to increasingly recognize the need to bring about change in practices, dealing non-audit services and audit services, get a fair fee for the work that we are doing, which will enable us to have the right level of infrastructure, to upskill, and to discharge our professional responsibilities in the manner that the standards, the law, and the regulator of the land expect us from. Thank you.
Thank you, CA Anant Marwaji. And it was indeed a excellent session taken by you, along with the excellent PowerPoint presentation. The good part of your presentation was it was in the form of questions, quiz, FAQs, whatever we call it. So it was easy for participants to understand and frame their queries or resolve their queries. So excellent presentation, and thank you for compiling so much of information for the betterment of the fraternity. So we have almost 460 participants for today's webinar, and it is an excellent strength. And I think everyone would have been using your inputs and will get benefited from the presentation. Thank you very much.
Thank you. I've thanked everybody, but there is no way in this medium to know the reaction per se, Nilesh ji. But I would want to take this opportunity to thank 460 members who are tuned in right now, and people outside their offices, outside their rooms also, for their patient listening. If there is anything that you want to get addressed now or later, the email addresses will be available, the numbers will be available with the committee. Happy to address, and thank you all. All the very best.
Just now there was a question which has popped up on the question board. So I'll just take 1 minute. The question is from Rajesh Shirsat, and he has a question on long-term loan installments not paid by the company regularly, but paid at the end of the year, then to be reported. In some case, one lender shifted to others, say ARCIL. Then this is to be report about changes in the audit report.
The essence of the question that I've understood, Nilesh ji, is this is the case like an evergreening kind of case, that one hat on the other, where,
Yes,
and therefore passing on the liability
deferring
when
it.
it's close to the due date, right? Whether
Yes.
you call it evergreening or whatever. A supreme example of a practice that may have existed or existing, but when it is visible, in fact, the RBI expects for auditors of NBFCs and banks to have specific audit procedures designed to check on evergreening. Caro, companies auditors report order, which is an annexure to the company's auditor's audit report, also requires specific procedures on it. Short answer, Rajesh ji, to your question is yes, it needs to be reported. In Caro, definitely. Does it need to be reported in the main audit report? Will really depend on whether the company or the client makes the adjustment and at least brings it back to current. And if they don't change the current non-current, then it could, depending on materiality, also require a modification in the audit report. A practice we should discourage unless backed up by business.
So as said by Anandji, that you can connect with him on email, and the institute will provide you the email IDs. So any queries, you can directly reach out to him. I think he will be graceful enough to give all the support and clarifications and correct guidance on the subject matter. So once again, thank you, CA Anant Marwa. It was indeed pleasure hosting you for this session, sir. Thank you.
Thank you. Thank you, the entire group.
So now we move on to our second session of the day. So we have with us CA Rachit Arora ji, who will be taking up the topic of recent issues and challenges under GST. So before handing over the session to him, it's my duty to introduce Rachit ji. Sir, you can unmute yourself. Yeah.
Yes, sir.
Yeah. So CA Rachit Arora ji is from Noyoda, and he has 7 years of experience in advisory and consulting practices with specialization in the area of indirect taxation. He is actively engaged in GST advisory and compliance matter, facilitating business restructuring, etc. He has also been filing representations before ministries and departments on behalf of various industries. So, Rachit ji, your session will be very useful for everyone. We have around 460 participants, and in today's practice era, GST is one of the hottest topic, and 7 years have gone by, and now we think the litigations and the issues which are cropping up and the daily notices which we receive, next 7 years will also be in the same fashion. But more light you can help us on this. Over to you, sir. Thank you.
Thank you. Thank you, Nilesh ji. And you rightly said that 7 years have passed by under GST, and it's a really long race and not a sprint that we can consider GST being here. And first of all, I would like to thank our chairman, sir, Purushottam sir, for having me here, and the entire team, Nilesh ji and Ajit ji, and the entire team for having me over here. I'm really grateful for that. And I think after such an insightful session by Anandji, it was really nice to hear him. And me, by myself being a GST practitioner and working on GST for the entire my life, and this studying and gaining this kind of a in-depth knowledge of audit, I think this was quite helpful. Thank you, Anand sir. Now, I think 460 members is a huge, I think it's a kind of a motivation for the speakers as well, that we are here to, we are giving our a little knowledge, we are sharing a little knowledge with these members, and I thank for all the 460 members. So I think we can move on to the topic. I'll just share my screen. And Nilesh, is it visible? Yeah, done. So I think this is the topic I chose to discuss the recent issues and challenges, because I think there are some issues which are being known to us, which are being highlighted by the department as well. And from past 7 years, we have been dealing with that, and we know how to deal with that as well. But now, today, I want to discuss those topics which somehow are being overlooked by the taxpayer, but not by the department. So if in case we are overlooking on a certain things that are being overlooked by us but not by the department, then definitely that invites notices from the department. We are not ready for that notice or demand, and we get stuck on a way which definitely requires in-depth analysis and competent advisory in relation to this. So I think I need to highlight these issues to make uh, our fellow professionals also aware about what are the challenges being highlighted by the department, what is the thought process behind each such issue raised by the department, and how can we deal with these issues in our professional environment, and also advise our clients accordingly. So the agenda or the topics that I would be covering is the pre-GST and GST, what is the difference and why these issues have been highlighted during this GST regime, and it was not the major issue under the pre-GST regime. And the issues broadly concerned are the corporate guarantee, which we are quite aware of because of the recent clarifications and the amendment that have been brought under GST law with regard to this corporate guarantee. Also, there is a lot fuss about this corporate guarantee. Then we have brand and logo. This is the most highlighted area which is being overlooked, and something which the department has definitely found a key to the pockets of the taxpayers. Then we have promotional schemes. Flexi payment plan for employees is another way of seeing to the things in between the employer and the employee, and how the transactions takes place, and how the departments foresee the tax liability under this. And then we have some export related issue, export of free samples. This is the area I specifically picked up, and this is from my experience from the last forum that I was delivering to, that this issue is being faced by a lot of businessmen and taxpayers who are dealing with the export products. So firstly, I would say, what is the difference between the pre-GST and GST regime? That when we talk about service tax, under service tax, there was this thing that the law stated that if there is no consideration towards a service, it does not tantamount or does not qualify to be a taxable supply or taxable service, and there is no tax liability arising on that. And this was a recent Supreme Court judgment as well in the Edelweiss Financial Limited that stated that this was specifically for corporate guarantee. It stated that in case there is a corporate guarantee being given by the company to a sister concern or a related or unrelated party, so in that case, since there is no consideration for that corporate guarantee, there shall be no taxability. This is just an example of supply without consideration. However, with the introduction of GST, there was a schedule 1 that was inserted in the definition of supply that stated that covered all the scenarios where the transaction would qualify as a supply. It will become taxable even if there is no consideration. So every one of us must have gone through this schedule 1 transactions, wherein if there is no consideration, and for example, you are having a transaction between your related party. What is a related party? For example, a subsidiary and a holding company is a related party under GST, and I'm having control or more than 25% of share in a company is qualified as a related party. So they say that if in case there is any kind of transaction between a related party and there is no consideration in that case, this supply definition says that it will be covered under the definition and that would become a taxable supply. So all those examples stated over here, corporate guarantee, brand or logo, and obviously related party transactions are all covered under the schedule 1. And why this becomes essential is because there is no such consideration. Whenever there is no such consideration, there is no accounting in the books of accounts. And when there is no accounting in the books of accounts, this area is being overlooked by the taxpayers. That at what scenario we'll call it an activity done by one person for another, or at what point we'll be qualifying it as a taxable supply. So I think we'll go by one. So the primary issue, or I would say hot plate issue, is the corporate guarantee that is being run by the department as well. Yeah. So what is a corporate guarantee? Corporate guarantee is, for example, there is a subsidiary company who takes a loan from the bank, and for that financial assistance, the bank generally requires a corporate guarantee. For the corporate guarantee, subsidiary company reaches out to its holding company that, see, I want a loan. I want the bank to sanction me a loan, and basis your confirmation or basis your guarantee, the bank will give me the loan. So if the guarantee says that if a subsidiary company fails to repay the loan amount to the bank, the holding company guarantees to pay the defaulted amount to the bank on behalf of the subsidiary company. Now, this transaction is somewhere very common in case of every corporate law, or in case of every corporate loan or financial assistance being obtained from the financial institution like a bank. So when this holding company gives a guarantee to the subsidiary, the department says that this is a corporate guarantee and this is an activity per se between the related person, where holding company is providing the guarantee service to the subsidiary company. Till now, what was happening was the law stated that in case there is if there is no consideration and there is an activity, you have to pay a tax that becomes a taxable supply. Now, how to value that supply? To value that supply, there is a rule. There's a first there's a charging section 15, that takes you to the rule which states that which talks about the valuation of a transaction between the related person. And that specific rule says that you choose, and that specifies the steps. First, you choose the open market value of a transaction. Then you see the quantity, kind of or quality of a supply, and then there are some more rules. 110% of the cost that is being incurred by the company while supplying the service or good supply of goods. However, the second proviso to Rule 28 says that in case, in the present example, if the subsidiary company is eligible for taking any kind of credit, if that subsidiary company is eligible for full credit of all the supplies while doing its business, then that holding company can charge any amount and pay tax. Now, why this clause was there? This clause was there because this is a revenue neutral clause. This does not give you this transaction if the subsidiary company is eligible for the credit. This provision was inserted with the intention that since this is a revenue neutral transaction, the government is not gaining any revenue out of it. So let's do one thing. Let's give an option to the taxpayer that the holding company can charge any amount, be it any nominal amount, which is declared on the invoice, and we'll accept that value of the taxable supply. Now, recently, a circular came in October 2023. It was recommended in 52nd GST Council meeting as well. It stated or it clarified that when no consideration directly or indirectly is paid by the company to the, okay, I'll just go to the corporate guarantee one. Yeah. So basically it clarified the taxability of the corporate guarantee provided for related persons, including corporate guarantee provided by the holding company to its subsidiary. And what it said was that they clarified that since this is a service provided by the holding company to the subsidiary company, we are not giving you the option of second proviso to Rule 28. We are defining a value to this. Why did they have to come to this? For example, take a scenario that a subsidiary company took a loan from the bank of 1,000 crores. Now, for that 1,000 crores, there was no open market value. In case that subsidiary company was not eligible for full ITC, maybe because that subsidiary company was dealing in exempt services. So on account of that, since that subsidiary company was not eligible for the full ITC, it had to go for the open market value. Now for open market value, there is no such service that is being offered in the market that for which a corporate guarantee is being, for which a consideration for the corporate guarantee is being obtained from the such kind of service recipients. In this case, it went to the courts. The courts decided, some of the courts decided that, okay, there is no open market value. What we'll do is the bank's commission that the banks charge for the corporate guarantee, we are going to impose that commission on you. That commission varied from 0.5% to 2.5%. And the court somewhere took a view that, okay, of that 1,000 crores, 2.5% is the value of the, shall be deemed to be the value of the taxable supply of service. And because of that value, you are liable to pay the tax at the rate of 18% or that 2.5% of the 1,000 crores. So 25 crores becomes your deemed taxable value, and on that pay the 18% along with the interest. Now these were the contention, these were the dispute that was being between the department and the taxpayers, and the courts, in the absence of any provision, were bound to take a view that what is the open market value of this corporate guarantee. Now because of this, the government had to clarify that what should be the value. Now they thought that, okay, let's bring it to one table and define that even in case the subsidiary company is eligible for that credit, the second proviso to Rule 28 that says take any value will not be applicable. We are specifically defining, and by notification number 52, we are specifically providing for the taxable value, that what should be the taxable value of the corporate guarantee between the related parties. They said that the taxable value of the supply of corporate guarantee between the related party shall be 1% of the amount of guarantee offered, or the actual consideration, whichever is higher. Now, in the instant example, if you talk about, if there is a guarantee of 1,000 crores, 1% becomes 10 crore rupees. That the rule says that this shall become the taxable value of the corporate guarantee, and this shall be the taxable value of the service that is being rendered by the holding company to the subsidiary company, and therefore you are liable to pay 18%. First question arose was, okay, this has been defined that corporate guarantee is taxable at the rate of the value of the corporate guarantee will be calculated at 1%. Now, will this be prospective or retrospective? This was not clarified by the government. However, whenever there is no such clarification in a notification that when it is effective, it is always deemed to be that it is effective from the date of the notification on which it has been published in the official gazette. So this was the notification date, that was 26th October. That was the deemed to be applicable date. Again, one more thing. When the circular came after the 52nd GST Council meeting, the circular, if you can see, the circular itself said that it specifically mentioned that the taxable value of such services will henceforth be determined as per the provision of this newly inserted sub-rule, which means that in any case, this should be applicable prospectively, and the department cannot generate any kind of demand for from a retrospective period, that is from 2017, from the inception of the GST. So this was something which was which can be said to be clarified by the circular itself. So what happens to the corporate guarantee services provided prior to 26th October, that is the effective date of notification? As we discussed, there was a rule, there was a second proviso as well. So when this valuation rule is applicable post 26th October, that is prospectively, the valuation rule will still be in force for any demand or any service of corporate guarantee provided prior to 26th October. And in case there arises any demand as on date, in case there has been no tax charge till date by a company or by the taxpayer, in that case, the law still prevails prior to 2610 that you can take any value as per the second proviso rule 28 and discharge your tax liability on that. However, interest and penalty can be definitely be charged, because interest is obviously compensatory in nature. Penalty can be definitely be argued or defended. However, the tax liability has to be discharged. So this seems to have been clarified by the department. However, now there are certain questions that may arise on this, because considering the today's practical agreements that are being entered in relation to the corporate guarantee, there have been various kinds of agreements. Now, agreements, I'll give you an example. The corporate guarantee agreement does not only specify that this is the corporate guarantee, the tenure of the corporate guarantee agreement also plays a major role in this. So if you enter into a contract as on date, as on today, and you enter into a corporate guarantee agreement for a period of 3 years, that this is a guarantee that I have provided for a 3-year period. Now the government do not qualify, or the notification does not clarify that whether this corporate guarantee will be applicable on yearly basis, on monthly basis, or there is any kind of clause that the corporate guarantee agreement should have, which clearly states that, or which clearly identifies that this shall be applicable on at the inception of the corporate guarantee when the corporate guarantee is given. Because see, you have to analyze that once you give the corporate guarantee, this is being the service rendered. Now the service is being rendered for a period of the tenure of the agreement. Now tenure of the agreement can be for 1 year as well, for 3 years as well, but the circular does not clarify. And I think for this purpose itself, there still requires a clarification from the department. Secondly, one interesting thing that has been come up yesterday, on Friday, Punjab and Haryana High Court has stayed this circular and has kept this circular on hold, quoting that there have been many discrepancies while assessing this value of 1% on the corporate guarantee. This has been a pan-India stay on the circular, which says that this 1% is liable to be taxed. And this is the case of Acme Clean Tech Solutions, in which Punjab and Haryana High Court has raised concerns over whatever the concerns are of the taxpayers as well, that there is no fixed period for which this corporate guarantee will be imposed. There is no such amount. For example, if corporate guarantee is being given for 1,000 crores, and the guarantor, although guarantor provides a guarantee of 1,000 crore, but the person receiving that guarantee does not invoke such guarantee before the bank, that guarantee is not invoked. In such case, will it be taxable or not? Because the service has not been utilized or received by the subsidiary company. Third question was raised was that even if that guarantee is given, this is guarantee is being given for the loan. If in now that guarantee promises that in case any loan is being disbursed to this subsidiary company, and in case the company defaults on the repayment, then the holding company will pay off the loan. But what if the subsidiary company does not get disbursed of the loan, does not go for the loan? It has taken the guarantee for being the eligible for the loan, but does not get the loan amount into its bank account. What happens in that case? Will that corporate guarantee still be said to be a supply between two related persons? So I think these areas were not clearly identified in the circular. Maybe this would have been issued this clarification could have come after a thoughtful process, but somehow right now the Punjab and Haryana High Court have put a stay on this. Most probably the department till date have been issuing the notices, and this might reduce the receipt of the notices to the taxpayers and provide a kind of a relief so that we can await for more clarification on these questions. So moving forward is brand and logo. Brand and logo again comes with I would say a hidden tax liability for the taxpayers. And how the department perceives is that if, for example, there are group companies in a particular group, and there are more. So there is, for example, ABC group, and there are multiple companies beneath that group. So all companies become a related party under the GST law because of the same shareholding or the same parent company being their holder. Now it says that the holding company or the parent company or the group head that has a trademark or a brand or a logo in its name and it's registered in India. Now that trademark is something which has an intrinsic value in itself. Why is it important? That trademark shows the identity of the company. Now every company that is beneath that or is a subsidiary or a group company of that holding company, that company might be indirectly or directly using that trademark. Either, I'll give you an exciting example. Whenever you go to a subsidiary company, you will see that the group company's stationery or the visiting cards of the personnel of the subsidiary do have a logo or trademark inscribed on that stationery or water bottles or gifts or any kind of boards that are being there to identify for the identification that this is a subsidiary of the group company. Now that using of brand, logo or trademark even on the stationery or visiting cards becomes a taxable supply in the eyes of the government. Now what the department says is that since you guys are a related party, the holding company or the subsidiary company are the related party, the subsidiary company is using the logo that is being owned and registered in the name of holding company, then that means that holding company has given or transferred the right to use that logo or trademark to the subsidiary company. And since this is an activity performed by the holding company to subsidiary company without a consideration, therefore it becomes taxable under Schedule 1 of the supply. So now this becomes, I think, a hidden treasure for the department, because whenever the department visits the companies or the subsidiary companies like these, they often tend to see those areas where the brand name of the holding company has been used in the subsidiary companies and in what way it has been used. Sometimes I'll tell you an interesting example that is currently being handled by the department as well, and I've been a recent part of that investigation as well. So there is a hotel by the name of ABC. Now how hotel business works is that hotel has a brand name as a company, and that operates or manages different kind of hotels in a country, but which are not owned by them, but which are managed by them. So there are two parties, hotel owners and the hotel company. Now hotel company gives rights to use its brand name to the hotels, for which they charges a royalty. However, they also run those certain kind of schemes like rewards or loyalty programs or any kind of such schemes that are being run or programs which are being run at the hotel for the customers, for the benefit of the customers, or identification of any schemes. And these hotel chains get those trademark registered in the name of themselves, so that in case those trademarks cannot be misused, or those trademarks are the identification for the particular scheme. Now the scheme boards are being placed at the hotels. The DGGI recently, in one of the case, went to the hotel and saw that, okay, this trademark is being used even in spite of the fact that this is a scheme that is being launched by the not by the hotel owner but by the company of the hotel. So they visited the hotel and they saw that trademark is being used over there by the reward this name, and we understand that this should be taxable. You show us the agreements and what kind of a royalty that you have charged. Now the brand or the logo that is being used over there, we are still fighting on the case that there has been no transfer, or we are still fighting on the merits of the case that how can this be said to be use of a trademark or use of a logo. So in every circumstance or every case, even if you are practicing or working in an industry, so I think for our clients or for our companies, we must go and check that what are our group companies, who all are our group companies, whether they are related or not. If they are related, then whether they are using our brand name or logo, those subsidiary companies are using the brand name of another company or such a concern or not. Even there might be a possible that holding company might be using a trademark in its head office of a subsidiary company to show that these are the group companies of us, and might be using that in their stationery or visiting cards. But there might be a possibility that logo is registered in the name of a subsidiary company. So it can be a vice versa case, and this has been a regular investigation point for the department as well, because this is something which we overlook. And this is not just in the domestic group or not just for the domestic company. This is also for happening within outside India. The company is having registered trademark outside India and giving that trademark to the group companies registered in India. So there is a classic example of all these white goods manufacturers. They have a parent company outside India. The parent company has the technical know-how that how that product has to be built. Even if I say for the Coca-Cola, they have the overseas entity. This is the Coca-Cola secret that everyone knows that it is being. This is something which is not registered overseas and it cannot be registered because of the secrecy part. But that Coca-Cola formula is being the procedure to manufacture Coca-Cola is being distributed without being supplying the main element of the product. This technical know-how that is being transferred from the overseas to the manufacturers in India or the group company in India, the Coca-Cola brand in India. Now the department says that this is a right to use that has been transferred from the overseas company to the Indian company. And this, since this is a right to use, the Indian company was liable to pay the tax and the reverse charge, considering this being the import of service transaction. So I think we need to analyze whether we are sitting outside India or in India. Our companies are situated outside India or in India. We need to analyze this part of the business as well, that whether any kind of brands, logos, trademarks, designs, or any kind of intellectual property is being registered in the name of one company and it's being directly, intentionally, unintentionally used by the subsidiary company, because this is the pinpoint that the department has been highlighting for really long now, and have been really serious about the investigation they carry out in this thing. Moving on to next is promotional schemes. So promotional schemes are the schemes which are generally provided in a chain of transactions. Why chain of transactions? Because the complexity arises. For example, there is a manufacturer, there is a distributor, and then there's a retailer, and then the customer. So this becomes a four-step supply, wherein the manufacturer supplies to the distributor supplies it to the retailers, and final retailer to the end consumer. Now, in this entire chain, the manufacturer is of the intention that, okay, the highest amount of sales done by the retailer would eventually benefit the manufacturer. The more the retailer will sell, the more benefit the manufacturer will get. And because of this, the manufacturer generally takes care of the incentives or schemes that are being run by the manufacturer for the benefit of the distributors or sub-distributors or retailers. So for example, I'll tell you, there's a phone of 20,000 rupees that is being supplied by manufacturer to the distributor. The distributor sells it at the price of 22,000 rupees with a 10% margin. And after 22,000, the retailer sells it for the 24,000 rupees in the market. Now, phone is something whose quality or whose technology deteriorates within a few months. So if you see, there is a model right now being available in the market. 6 months later, there is another model. 6 months later, there is another model. So when the manufacturer is giving up this or supplying this phones or particular product, mobile phone, to the distributor and then to the retailer and to the customers, he ensures that as per his view, he wants that all the material or all the products that are being sold in the market or are being available in the market are being sold as soon as possible so that he can launch the new product, new model. For this, he gives a post-supply discount. Now, post-supply discount, you have to see firstly the provision, that is section 15, subsection 3, which specifically talks about that post-supply discount is only eligible to be reduced from the transaction value on which GST is not liable to be paid, only when there are 3 conditions that are being fulfilled. Post-supply discount has to be mentioned in an agreement with the customer. So if manufacturer is selling it to the distributor and any kind of post-supply discount is being given on that 20,000 rupees, it has to be agreed before the time of supply, at the time of supply or before the time of supply, so that that discount is being recorded in the agreement. The distributor is known, the distributor is aware of the discount that can be given to him after the supply that is being made by this manufacturer to the distributor. Secondly, it says that it has to be linked with the relevant invoices. So today I am issuing an invoice for invoice number 001, and at a later point of time, after a period of 6 months, I issue a credit note. If I want to give you a discount, it should come into the agreement, as well as I want to know that the provision states that the manufacturer should be knowing that against which invoice that discount is being given, under which invoice, and you have to link it with that invoice. So the credit note has to have that linkage with the original invoice. And third and the foremost and the most tricky condition is that the credit of that invoice that was for 20,000, the credit pertaining to that post-supply discount should be reversed by the recipient of the supply. This is the most trickiest part, and I think we are all stuck over here in many cases whenever the provisions ask for the dependency on the other participant of a transaction. For example, a taxpayer, a supplier, and the recipient. If the recipient has not reversed any credit pertaining to a credit note, then the rope hangs in the neck of the supplier, as we all know. The department issues the notice first to the supplier and then to the recipient that why their credit was not reversed. So similarly, if we see the post-supply discount, these 3 conditions have to be fulfilled. Now, in the example that we took, the post-supply discount, for example, you mentioned that, okay, if the distributor reaches a target of 1 lakh mobile phones in a particular year, I'll be giving him a discount of 10% of the total sales. Now, if that total sales amounts to 100 crores, that 10% amount comes out to be 10 crores, or 10 crores I'll be giving discount to the distributor by way of a credit note. This is generally what the manufacturer does, and many of us have been seeing as well in our general post-supply discounts as well. The manufacturer will give him a discount of 10 crores and issue a post-supply discount. Now, these 3 conditions have to be fulfilled, that this had to be specified in the agreement. This had to be linked with the relevant invoices. Okay, relevant invoices can be linked by saying that these are the one, the entire year invoices, and we are linking with this. Okay, done. Third condition, that the distributor should have reversed the credit pertaining to that post-supply discount. In this case, what generally manufacturer does is, and as a safeguard measure, we also suggest to our clients that take an undertaking from the distributor that he has reversed the credit, because as per him, he must have reversed it or not. But you take an undertaking to say that we have taken a precautionary measure, and this is the most far-fetched thing a supplier can do while issuing a credit note. But what happens when that promotional scheme, this was a basic promotional scheme. What happens when the manufacturer decides to launch a different kind of a promotional scheme? For example, the manufacturer, since in the chain of all these participants of a transaction, The manufacturer knows that there are 100 phones that are being kept at the retail outlets. Now I want those 100 phones to get to the customers as soon as possible, and I want those phones to be supplied as soon as possible. So what he will do is, he will tell to the distributor that, okay, see, you give a discount to the retailer. 20,000 rupees phone I gave it to you. You gave it at a price of 22,000 rupees. You give a discount of 2,000 rupees to the retailer. The retailer will give a discount to the customer of 2,000 rupees, and I will reimburse you, or I will give you a discount for the 2,000 rupees that you are giving it to the retailer. So the hit of 2,000 rupees is being faced by the manufacturer. However, how this transaction has happened, this might seem a simple transaction where discount is just being passed on, and there are conditions, all conditions are fulfilled. There is an agreement, all the relevant invoices are linked, and the retailer or the distributor must have reversed the credit as well, considering this fact. Then also, how the department says in the recent judgment of the Tata Motors as well, the department says that the discount that is of 2,000 rupees that is being offered by the manufacturer to the retailer is now what has happened is, the retailer has given up that product of 24,000 that he was required to charge from the customer for rupees 22,000 rupees, and the customer has paid him 22,000. But did the retailer receive 22,000? No. The retailer received entire 24,000 by virtue of 2,000 rupees discount that was being given by the distributor to the retailer, because his profit margin is still that 2,000 rupees that he was earning before the post sale discount, and now also he is earning 2,000 rupees discount. So this sale or this consideration cannot be called as a 22,000 rupees sale. They say that this is a third party consideration, because third party consideration, or I would say, as per the definition of consideration under section 2 subsection 32, that says that consideration is the consideration received from the recipient of the supply, as well as by any person or any other person. So for the retailer, that recipient of the supply was the customer, and any other person was eventually the manufacturer, who gave him the 2,000 rupees discount by way of passing on it through the distributor. So in that case, the department says that the supply at the end of retailer was not for 22,000, it was for 24,000, wherein 22,000 was given by the customer, and 2,000 rupees is being rendered by is being remitted by the manufacturer. So what is the tax liability of retailer at this point of time? He says that tax liability is on 24,000 and not 22,000. Secondly, that comes to distributor as well. The distributor says, I had issued an invoice for 22,000, and 2,000 was the discount and this discount was passed on by way of a credit note. Again, applying the same logic, the department says, no, this is not the taxable liability. Again, the supply was made for 22,000, wherein 2,000 you have 20,000 you have received from the retailer, and rest of the 2,000 is being received from the manufacturer. So once you say that this is being the transaction, now department says, once this transaction happened, the entire company was running this business, or I would say many industries, not just the mobile companies, many industries have been working on this kind of a model, wherein the schemes have been run even for the motor industries, car industries, hotel industries, or any kind of industry you take it up for the retail or marketing. Every industry passes on their discounts through their distributors to the retailers to increase their sales. However, the department has raised a concern over this, and there is, I would say, hundreds and crores of notices that are being received by these companies, stating that these are not the discounts, these are not the eligibility criteria for issuing a credit note, and thus it cannot be reduced from the transaction value. So there are multiple questions which comes up, that whether issuance of GST credit note by the supplier is mandatory. So now it will say that, okay, the client would say that if you are saying that GST credit note, I don't want, if issuing a GST credit note is creating a problem. So what should we do? How should we take up this transaction? So in this case, there is a document by the way of by the name of a financial credit note or commercial credit note. Even in the present case, we are advising our clients not to issue a GST credit note in this case, but to issue a commercial credit note in this case, because a commercial credit note document only takes up the financial transaction and have no implications of GST or tax demand or reversal of input tax credit. And this has been clarified by the circular itself that in case there is a commercial credit note that is being issued, there is no requirement for reversal of the credit. Because in the chain, sometimes this happens is, although we advise to the client that issue a commercial credit note and then you can take up this transaction, but the distributors or the retailers are coming up to the manufacturer that, okay, no, we are not going to accept this commercial credit note because we are then liable to reverse our input tax credit on account of the condition that we have not paid you the money of that amount. Because if a phone was sold for 20,000 rupees and I am paying you only 18,000 rupees because 2,000 rupees is the credit note which you have issued upon me, a GST commercial credit note, then I am liable to pay you only 18,000. So in that case, I will not accept it, because if I pay you 18,000, I will not be able to take the credit of that 20,000 tax applied on the 20,000 rupees. So the department has already clarified, although that circular is rescinded as on date, but still we can take a stand or argue on that commercial credit note, upon commercial issuance of commercial credit note, this will be deemed that this transaction has been completed. There is no liability from the recipient of the supply to be paid to the supplier. Now, this also gets supported by the law. How it gets supported? Because section 16.4 or 16.2 proviso says that the condition of 180 days payment. Why this is important is the condition of the 180 days payment specifically talks about, it starts with the clauses, or it starts with the wordings where the recipient of the supply fails to pay to the supplier. So in case, now this fails to pay has been analyzed by the courts as well, and the court said that when both the parties agree that there is a failure to pay, only in that case this provision can be invoked. So if uh, I, as a person, makes a supply to another person, say Nilesh ji, and if I agree with Nilesh ji, okay, you give me only, this was a 1 lakh rupees supply, okay, I have given you 1 lakh rupees opinion, okay, after a period of time, I've issued you the invoice as well, and you are taking this for in furtherance of your business. Now, after our negotiation, he says that, okay, I'll pay you 1 rupee, and you settle our accounts. And if I accept that 1 rupee and settle our accounts in our books of accounts, then that says that fulfills the condition of 180 days, that or fulfills the condition of 16.2, that Nilesh ji has given me the entire consideration and he did not fail to pay, because this was agreed between me and him, that I will settle the amount with 1 rupee as well, in spite of he paying me the entire money of 1 lakh, and still he'll be eligible for the entire credit. And this has been very well taken by the and accepted by the courts as well and the department. I think before proceeding ahead, I should definitely ask Nilesh ji if there are any questions, so that we can take that up till the sessions we have taken up right now. Nilesh ji, am I audible? Nilesh ji, can we move ahead? Okay, I think just saving the time, we can move ahead. And in the meanwhile, if Nilesh ji can answer. Yeah, so we have already taken up this third party consideration and what post supply discount is, and there have been various rulings on these promotional schemes as well, wherein we state specifically wherein in Ultratech Cement or Santosh distributors, in Ultratech Cement also they specified that in case you are agreeing with the distributor that this kind of a discount will be given to you after later period of time, you have to quantify that discount. The advanced authority said that you have to quantify this discount, and you can't just write in the agreement in an open-ended statement that we'll give you a discount depending upon the nature of the discount or nature of the scheme that is being decided by the company from time to time. So you can't give it in an open-ended statement. You have to quantify, or at least you have to tell the manner in which that quantification will take place at a later point of time. In Santosh distributor, what we recently discussed, this was a third-party consideration case where there was a chain of transaction or chain of parties to the transaction, and therefore they decided that okay, this amount that is being paid by the customer and the discount amount that is being offered by the manufacturer by way of manufacturer to the distributor to the retailer will add up both the amounts, and only then it will become the transaction value, and there will be no reduction in the transaction value of the supply given by the retailer. And we have certain similar kind of gold and tobacco judgments, offer of free cigarette buy one get one, and distributor received on volume discounts and quality mobiles. Nileji, if you can tell me if there are any questions till now, because these have been some certain issues which we have been facing quite.
Yes. So there are two questions that has come up on the portal. So first question is it any different when it comes to personal guarantee to a related party?
Yeah, we can take that up as well, I think.
And the second question is holding company charges monthly contribution to its subsidiary for various services. Is it mandatory for it to specifically mention for usage of brand?
Okay.
And there is one more question. Sir, could you please touch upon broadly on applicability of GST on sale of assets of the corporate debtor under liquidation under IBC 2016?
Okay. I think the applicability of sale of assets, definitely we can take that up. But moving ahead, before moving ahead, firstly, the prime personal guarantee, if you talk about, the clarifications in the 52nd GST Council meeting were also discussing the personal guarantee issue, wherein when the directors usually, in the capacity of being a director, sometimes they are obligated to give the guarantee just because they are the directors of the company, and the loan sanctioned to the company, the banks required that guarantee from the directors. The circular also stated that although uh, the RBI restricts the directors to give any kind of personal guarantee to the company in the capacity of the director, however, even in case the director is issuing any kind of guarantee being in the capacity of that, in the individual capacity or being in the capacity of the director, in that case, this cannot be said to be the supply, or even if it is for the supply, an intention behind this personal guarantee is that because he is sitting in that position where he is actually not liable to take any consideration from the company with regard to the guarantee given, because he's in a position to be in the capacity of director, he is giving the guarantee. So since he cannot charge, the RBI restricts the consideration part, not the guarantee part. The RBI restricts the director cannot charge. So now since the directors cannot charge anything for the guarantee given in the capacity of the directors, therefore taking into consideration this restriction, the market value or the consideration cannot be decided. Open market value cannot be decided in this case. And since the open market value of this transaction cannot be decided, it should be deemed to be it should be treated to be as zero. And since this is treated to be as zero, there shall be no tax payable in this risk. I think this clarifies the personal guarantee point now, because the intention of the circular was linked with the RBI restriction. So that is the reason there is no tax on the personal guarantee given by the directors. Coming to the next point was, if the company is charging a monthly contribution, I suppose this is in respect of the support services that generally is being cross-charged by the sister within the sister concern. So yes, you're right. Support services do suffice, but subject to the condition that the recipient company is eligible for full credit. So if the recipient company is not eligible for the full credit, then in that case, you would have to definitely take this up as a separate consideration, because you will have to identify the open market value of each such service, and you can't just take a nominal or a cumulative amount for that support service. You are charging on monthly contribution, in lieu of which you are receiving monthly consideration. However, whenever there is an aspect that, okay, your service recipient company is being eligible for the full credit, and you are also falling under that second proviso to Rule 28, the rule allows you to take any kind of credit. Rules allows you to take any value for that, the bouquet of services that you are rendering or support services, and you are right in charging monthly contribution. However, to substantiate that your brand logo fees is also being recovered, you must enter into an internal memorandum of understanding that these are the services that we are charging you for, and these are the services for which we are cross charging you for, which should include brand or logo usage as well. Why is it that this important is, tomorrow if the department comes to your door and asks you are not charged for the brand and logo, you can definitely say, see, firstly, Rule 28 gives me the power to charge any value. I have charged a monthly contribution for this entire bouquet of services, that the support that I am giving it to the sister concern. Thirdly, my memorandum of understanding, which has been clearly communicated with the companies, clearly states that the consideration has been received by you on account of these services being rendered by me. Now, I have rendered you a service. This has been cleared by way of MOU. I am charging a consideration for that service. This has been clear, and I am paying tax on that. And the valuation is also in accordance with the law. So you are fulfilling all the parameters by just entering into the memorandum of understanding for all the cross-charge services. And it is not just for the brand and logo. For all the cross-charge that we do, we generally issue a support service invoice stating that, okay, this is the 1 lakh rupees invoice issued to the company, and we are discharged the tax on the service support service as well, paid the tax at the rate of 18%, and this discharges me of my duties. But however, the department will come to you and will ask you that how do you, or how the company know, the recipient knows that these are the services that you have rendered to him, and you are charged their consideration for that. And how does the department know that for what consideration you have charged? Just by, because we do not generally have an agreement for cross charge. We do not have any kind of ledger for cross charge. We specify these are the costs that are being incurred. So a memorandum of understanding is a clear, helpful document which can help you sustain or defend your ground, that these are monthly contribution. You need not change any kind of contribution value, but enter into one more MOU and comply with all the compliances. So third question is applicability on sale of assets under liquidation. Under liquidation, what generally happens is that the company gets into merger by way of either NCLT order. I believe this is for the NCLT order itself, that by way of NCLT order, there are sale of assets. So by way of that, the assets get transferred to the new company by way of that NCLT order, and all the assets and liabilities are stated to be transferred to the new company. And when this kind of a transaction takes place, it generally happens on a going concern basis. Okay, this was the company been running over there, and this is being transferred to the new company by way of that NCLT order. That the company went into liquidation, and all the running assets, all the running liabilities have been transferred. And this is the reason we call it as a going concern. If I'm on the wrong path, do let me know that whether this question was on a going concern basis or on a different angle. However, while answering a going concern, the how do you judge a going concern or not? That whether all the assets and all the liabilities, the law states that all the assets and all the liabilities have been transferred to the new company or not. The assets and liabilities required, now since we see all the assets and liabilities through a balance sheet, however, the courts perceive it as okay, if even if there are certain assets and liabilities that are being retained by the earlier company or are being retained, are not being transferred to the new company, then also all the assets and liabilities which are required for the regular operations of the business which was carried on prior to the transfer, prior to the liquidation and post liquidation as well, if those required assets and liabilities or necessary assets and liabilities have been transferred, even in that case it will become a going concern. And as per this GST law, going concern has been put into the exempt bracket, which says that the service of transfer of a going concern into a new company qualifies as a exempt supply, and there is no requirement to issue a tax invoice for it. So let me know if I was on the right path for the sale of assets or not. And Nileji, do we have time to cover more issues or?
It's already 18, crossing 6. So only one last question is available. Corporate guarantee before 30/6/2070. Then GST is payable on the same if the same guarantee continues till 2021.
मिजाज है बस.
Did you hear the question?
Yeah, Nileji. So I think this, what logic we are applying in GST as well, that even post GST or prior to GST, whenever there is a corporate guarantee agreement entered into between two companies, the time of supply of that guarantee arises at the time of agreement or inception of the agreement between the corporate guarantee. So if in case this has been entered prior to GST period 36/2017, the time of supply for that specific agreement lies and prior to GST. So there arises no GST liability, even if it continues to be supplied or continue the tenure of the agreement enters the GST period as well. So on the similar ground, if in case the this transition period for introduction of this new rule that has been come into force with effect from 27th October 2023, in that case as well, there were many questions that if my agreement has entered prior to 27/10/2023, which we also covered in the presentation, then what would happen if that is being recurring or that is being continuing guarantee for a period of 3 years? Now, will I be supposed to pay a 1% tax on 1% corporate guarantee value or not? This has been clearly specified that this is a prospective amendment, and any kind of an arrangement that is being entered prior to the date of 27 October 2023, be it prior to the GST period as well, even in that case, the time of supply has to be seen. This is the understanding that time of supply has to be seen at the inception of the agreement and not on the tenure of the agreement. So I think this answers the query.
Okay.
Anything else, sir?
Sir, question is on both going concern and also piecemeal sale of assets, please. I think this is from this corporate debtors liquidation part. I think we can take this up.
We can take this up. Do we have time for this?
Yeah. 2 minutes more.
So can you pardon the question? That it was a
he's asking that it is for both going concern and also piecemeal sale assets, piecemeal sale of assets.
I think in piecemeal sale of assets, during that liquidation, if there's a piecemeal sale of asset and not a going concern, it has to be considered as a single. I mean, if the consideration has been defined for each of the assets, and that consideration has to be charged by the company or the transferee company. In that case, this would be nothing but a simple supply transaction of the assets, since the liabilities has not been assigned along with those assets. So you cannot call it as a wholesome or a lump sum transaction. When you identify those assets to be supplied to or to be transferred, the ownership of those assets to be transferred to the transferee company, in that case, you have to consider it as a simple supply transaction of the goods with respect to the assets are concerned.
Okay. So I think we have justified the question answer session, and in case the participants have any other questions, they can send it on email, and in the flyer.
I'll share my email ID as well.
They can send the email to cpadmin@ICAI or else directly to the speaker. So it's Rachit Arora 0711@gmail.com. So till you note down the email ID, first of all, today's speaker for the GST, challenges under GST, I would like to wholeheartedly, on behalf of all the participants and ICAI and the CP committee, I would like to thank CA Rachit Arora for a wonderful session, and I think he has taken up many relevant issues related to GST, and which are very much critical for our day-to-day business, day-to-day activities of our clients' business. So thank you, Rachit ji, for a elaborate session on GST challenges. I think the GST challenges are endless, and we would be regularly inviting you for such similar sessions in future also. So at the end, I would also thank all the participants. Almost 460 participants have joined us today, and it was a wonderful initiative by Continuing Professional Education Committee under the chairmanship of Purushottam Lalji Khandelwal and Vice Chairman CA Gyan Chandra Mishra ji for such a wonderful initiative and knowledge imparting sessions that our members are benefited from. So I'll request every member to regularly join such sessions and encourage the organizers by participating in large numbers. I would also thank the support team, Secretary Shrey, and other members of the team for organizing this Zoom session and helping the participants sitting in their offices or wherever they feel comfortable and learning on regular basis. Thank you, everyone. So with this, we will end this session. Thank you. See you soon. Bye.
Thank you, sir.